Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, Global Strategist at Yuanta Securities. Mr. Yu, good afternoon. Thank you for coming on today.
Good afternoon.
Well, let's start on Wall Street, where U.S. stocks had a strong start to the month of October. Of course, coming off a very rough September, Treasury yields have come down. That helped send the Dow up by more than 2.5% and the Nasdaq 2.25%. What's behind this bounce back in global stocks?
Yes, if you look at the Dow Jones, it rose by 800 points, rising by 2.66%. And S&P 500 is up 2.6, and Nasdaq is up 2.3. All in all, it's quite a bit of a strong rebound that we saw. This is because of the uncertainty regarding the overall inflationary pressure and the Fed's hawkishness. We are expected to see some of that to be diminished over the period of time, because we saw a news of the ISM Purchasing Manager Index showing that manufacturing activities are showing a very slow pace in 30 months as new orders headed into a contractionary territories. So with this kind of news, we did see the yield falling to 3.6% or below for 10-year U.S. government bond rate, which is clearly much below than what Fed chairmen have been saying in terms of the raising interest rate. Also, we are looking quite closely at what might be happening to U.S. job report on September. And that is actually, if that number comes in too strong, then obviously people will be uncertain about the rates and also Fed's hawkishness, and that caused the additional decline in the future. But for the time being, it seems that the market is continuing to show a rising trend. The futures market for U.S. is showing a more than 1% plus right now, and the rates are falling even further to 3.57% for the 10-year government bond rate, and also for 5 years, it's also down by about 2.61%. In terms of the corporate side, we did see quite a significant decline of Tesla share prices by 7%. After the electric car makers' quarterly vehicle deliveries fell short of the analyst estimates. But we think that it's a bit of a transitional period. We think that the overall growth number is still intact, and therefore the electric car growth rate is still very strong in global economies, including U.S. And we think that the overall, the sector-wise, the interest will continue to remain quite strong. In terms of how the U.S. market will play out, it really all depends on what kind of inflationary numbers comes out over this month, and also what Fed are expected to do over the next 6 months or so. We are estimating that inflation will be falling to less than 4% by the March of next year. So later, the pace of the rate hike might be stopping by the end of this year, maybe the beginning of next year. We will probably add no more additional rate hike might be happening. And if that's the case, then market can further rise. But for the time being, still, we need to watch out what might be happening to the inflation and what Fed might be doing over the next several months.
Right. Well, it seemed to be a similar story here in Korea today, with the KOSPI up about 2.5%, breaking back above 2,200 points. The KOSDAQ up 3.5%, and the exchange rate easing off a little bit to under 14.30 to the dollar. Big gains for Korea's top names today. Tell us about the domestic market.
Yes, we're continuing to be confused about what's happening to overall manufacturing sector. But it seems that the earnings-wise, we are expected to show a very strong number, even in the third quarter. Anyway, for the time being, we saw Korea's PMI declining to below 50, and that is causing uncertainties. And clearly, Korea's trade gap has been larger than expected in September, showing about 3.7 billion won of deficit. Despite all that, we think that the currency movement well above 1,400 plus is overshooting in terms of the fundamentals, in terms of the government debt level, in terms of the foreign reserves. We don't see a fundamental problem for Korea. Of course, we do have a short-term debt issues because of a lot of the debts are much shorter terms than U.S. and therefore the rate is affecting quite negatively in terms of the currency-wise. But even including all that, we think that the level of the debt of government and corporate are not significant enough to show this kind of negative movement in terms of the currency. So we do expect the currency to stabilize gradually. And as you said, the Korean won has declined to about 14.27, falling by 12 won to dollar. Quite a significant move there, and that causes the overall Korean markets to rise by over 2.5% for KOSPI and 3.6% for KOSDAQ. Of course, we need to watch out carefully what's happening to currency and also export numbers. A lot of data is coming out from the export players of Korea seem to show continuation of the market share gains, particularly auto sectors. We saw Kia and Hyundai showing overseas shipment or the sales number, units number is rising by two-digit number even in September. So clearly these kind of news are definitely positive. We think the market is in good position because it has been declining significantly to the level that is as low price to book level as 2008, which is 0.8 times the book.
Well, zooming out a bit, we see the premium on Korea's credit default swaps, which indicates credit risk, is actually higher than it was in 2020 in the early days of the pandemic. The government's saying, though, that it's confident there won't be a crisis. Could you tell us a little bit about what that means and what you make of the situation, Mr. Yu?
Yes, I think that really it all depends on what's happening to the currency. If you look at the Korea CDS, it was about 25 basis points at the beginning of last year. It did go up to as high as 55 at the beginning of the year, and then has fallen to 35. Now it's back up again to 60, which is above the previous high of the 55. So clearly people are uncertain about what's happening to the Korean economy. Of course, when you have a much higher interest rate environment, given the fact that the debt level of the Korean consumers are extremely high, which is around 100% plus of the GDP, and a higher number of the interest rate will cause the uncertainty for the Korean consumers. And that is causing the uncertainties. And also we are seeing quite significant level of the property prices decline this year. However, though, we think that there's no reason for Korea to raise interest rate to the speed of U.S., given the fact that if you look at the overall debt level of the government and also debt level of the corporate sector is quite reasonably strong. So therefore, we think that this kind of movement that we are seeing is a bit of a short-lived, we think, in the future. Of course, a lot of people are worried about 2008 global financial crisis repeat of that, but we don't think that that will be happening on the basis of overall fundamentals of the economy seems to be quite reasonably strong. Especially the U.S. as well as China, we are expect to see continuation of strong policies. China is actually increasing the overall support level for the economy. And as for U.S., yes, they are raising interest rate much faster than expected. But despite all that, we don't think that government will be in position to raise it to this too much higher level, given the fact that the currency already hit as high as 11.15 dollar index-wise. We think that the U.S. will be easing out in terms of the tight policies. So all that means is that Korea will be in a good position. A lot of uncertainty still remains, but nevertheless, we think that a lot of overshooting to the downside is already finished. And gradually, we think that the market could be in good position to recover. And even the CDS numbers will be also normalizing gradually over the next few months.
Well, that is reassuring, Mr. Yu. We'll keep an eye on it with your help, of course. Thank you, as always, for coming on the program. We appreciate your insights.
Thank you very much.